Welcome to The Explainer. Today, we are going to decode the fascinating and, frankly, kind of terrifying reality of the 2026 AI market paradox. We're looking at a landscape that's completely defined by historic capital investments, revolutionary technology, and, quietly, some of the most concentrated financial risk we've seen in decades. So let's just jump right into the central mystery here. We all know artificial intelligence is being hailed as the ultimate future of, well, everything. Yet top regulators, like the Bank for International Settlements, literally the central bank of central banks, are raising massive red flags on global economies. They're formally warning that a disappointment in returns could trigger a sudden, brutal withdrawal of financing. And this brings us to a really profound, counterintuitive insight. When everyone is wildly optimistic and prices are sitting at all-time highs, the danger of permanent capital loss is actually at its absolute peak. You see, risk isn't just about market volatility, right? It's about the blind spots that get created when the entire market believes a technological trend is just a guaranteed ticket to infinite profits. Think of the current situation like a giant financial funnel. At the top, we are pouring an unbelievable $1 trillion into global AI capital expenditure for 2026. But if you look at what's actually dripping out the bottom, it's only about $100 billion in genuine enterprise generative AI revenue. That is a massive historic monetization deficit. Part 1. The trillion-dollar CapEx gap. Let's unpack the invisible financial mechanics. To really get this, you have to understand capital expenditure, or CapEx, which is currently acting like a delayed detonator for corporate profit margins. When a hyperscaler goes out and buys billions in GPUs, the cash leaves the building, but it doesn't immediately crush their income statement. But here's the catch. Those assets eventually have to depreciate. The massive costs hit the balance sheet today, sure, but those crushing depreciation charges are going to hit the income statement years down the line, acting like a ticking time bomb for future profits. The shift we're seeing right now is just staggering. The world's top 5 cloud providers went from spending a manageable 40% of their operating cash flow on CapEx back in 2023 to reinvesting an incredible 94% of it by 2026. They've essentially pivoted from being these asset-light cash cows into highly capital-intensive infrastructure builders, literally almost overnight. And this dynamic creates a brutal cash flow squeeze. Take Microsoft, for example. Their quarterly free cash flow recently dropped to $15.8 billion, which is actually down from the previous year, despite them posting absolute record revenues. It is the ultimate cash flow squeeze, driven entirely by the sheer front-loaded cost of building out all these AI data centers. Part 2. The circular financing illusion. How the AI ecosystem is artificially inflating demand. So how does this circular financing actually work? It is a highly dangerous loop where capital essentially just circulates internally. A major tech giant invests billions into an AI lab, but that lab is contractually obligated to spend those exact funds renting cloud compute right back from the tech giant. The giant then turns around and reports that compute usage to Wall Street as AI revenue. It's a closed loop. They're essentially paying themselves, making end-user demand look far more robust than it actually is in reality. It's honestly like building a skyscraper on a foundation that's actively on fire. Just consider the Microsoft and OpenAI dynamic. Almost half of Microsoft's massive $627 billion contracted revenue backlog rests on just one single customer, OpenAI. And that customer is highly unprofitable, projecting a cash burn of $14 billion in 2026 alone. This loop is so incredibly risky that even NVIDIA is pumping the brakes. They recently backed out of a massive partnership precisely because they realized they might just be paying for their own products. When the ultimate hardware supplier looks at the balance sheet of the most famous AI startup in the world and decides to slash a $100 billion deal down to $20 billion out of fear of artificial demand, yeah, we really need to pay attention. Which brings us to part 3, the hidden debt. How the 2026 AI expansion is actually being funded. Well, because self-generated cash just isn't cutting it anymore, hyperscalers issued a staggering $182 billion in corporate debt in 2025 alone just to keep the servers running. This represents a historic business model transformation. Big tech is systematically turning to the bond markets, issuing debt backed not by traditional, solid assets like real estate, but by rapidly depreciating GPU servers and software contracts. But you know what's really alarming the Bank for International Settlements? It's the shadow risk. Private credit is out there issuing massive loans based on nothing but projected future AI revenue, rather than hard collateralized assets. The visible risk in corporate bonds is one thing for sure, but when off-balance sheet shadow borrowing infiltrates the private credit markets to fund cash-burning software startups, that fragility penetrates the absolute core of our traditional financial system. Part 4. Will this bubble burst? Let's trace the transmission pathways of a potential tech crash. When you map out historical contagion pathways, it becomes really clear that a 2026 crash wouldn't look anything like the 2008 banking freeze. Because this AI expansion is funded by corporate balance sheets rather than highly leveraged retail mortgages, a correction wouldn't necessarily break the commercial banks. Instead, it would closely mirror the 2000 dot-com bust, creating a severe corporate capex recession and a public equity shock that would heavily impact private equity valuations and overall market multiples. And the vulnerability right now is incredibly concentrated. I mean, an absolutely massive 45% of the broader S&P 500's entire weight is tied directly to just a handful of AI-related tech stocks. The stock market's performance is so narrow. If you exclude these giant infrastructure builders, the broader equity market has effectively just traded sideways. That means the entire index rests entirely on the success of this single capex cycle. So why does this matter to you and me? It's the wealth effect. Because everyday retail investors are so heavily concentrated in tech today, an AI stock correction would immediately and severely contract global consumer spending. We have gone from a 9-cent drop to a 34-cent drop in actual consumer spending for every single dollar of paper wealth lost. A tech correction today would hit the real Main Street economy much faster and much harder than it ever did in the past. Finally, Part 5, Surviving the New Era, Building Resilience Through Intellectual Humility. The legendary Charlie Munger always championed intellectual humility, and it is so relevant here. We have to separate the genuine, world-changing power of AI technology from the currently overhyped investment vehicles that are funding it. Listen, a revolutionary technology does not automatically guarantee speculative investment success. We have to be willing to look hard at the bearish arguments, the depreciation bombs, the circular financing, if we want to make rational decisions. So, to protect your capital, the data strongly points to an anti-bubble strategy. You want to focus your portfolio on cash-generating, profitable businesses that are currently being ignored and underpriced. Look for the deployers, boring, cash-rich companies in healthcare, financials, or consumer brands. These guys are quietly using AI to structurally lower their own costs and expand their profit margins, all while their stock just sits there at a multi-decade low simply because they don't have a flashy AI narrative attached to them. I'm going to leave you with this final thought to wrap up our explainer today. When the speculative music stops, and it always does, is your portfolio prepared for a market that suddenly demands actual, real free cash flow over future promises? Because understanding the hidden mechanics of this trillion-dollar cycle isn't just about trying to predict the future, it's about positioning yourself to be incredibly resilient no matter what happens next.